Good afternoon and good morning for our friends on the West Coast. Thank you for joining McQueen Financial's Advisors Maximizing ALM Decision Making Now and Post COVID-19. This is Charlie McQueen. Thrilled to have you with us today. Thank you very much for joining us. Today, I'm really excited. We have two of our incredible advisors with us today. We have Chris Mueller out of our New York office. Chris is going to be talking about ALM. Chris has been in the industry for an appropriate amount of time, and probably I'd say a long time, but that'd probably be not the best word choice. But Chris has been with us for a long time and working in the industry for quite a long time. Chris has a great understanding of balance sheet management and investment skills. Chris is part of our investment advisory team also at McQueen Financial Advisor, and Chris is actually an awesome author who has written numerous articles. So we're really excited to have Chris with us as a co-presenter today. Also, we have Dan Freelow. Dan is one of our senior ALM advisors out of our California office outside of LA. We're excited to have Dan here. Dan has a great level of experience talking about interest rate risk management, regulatory guidelines, growth strategies, and all sorts of great experience. Really excited to have Dan here. Dan also heads up our ALM Validation team at McQueen Financial Advisors. So thank you, Chris. Thank you, Dan, for joining me today. Today, a couple things from an administrative standpoint. If you have a question, there is the question button on the bar. Please feel free to put a question in there and we will answer it. If it's appropriate, we'll interrupt the conversation and answer it. Otherwise, we'll add it to the end of the presentation. Today's webinar is being recorded and will be available to you and your team. Just let us know if you'd like a copy of it. We do have CPE eligible webinar today, so if you do need CPE credit, just stick around and answer a few questions and we'll get you a certificate in the mail. So today, we have four major points to cover. We're going to do an economic update. Some of you know we just released our Q2 economic outlook. We're going to cover some of the high points of that today. We're going to talk about asset liability management in a post-COVID world and talk about ALM validation. And then in the end, we're going to have some time for questions and question and answer time frame. So without further ado, and to keep us on schedule today, wanted to kick off our economic update. And the first thing I want to do is talk about the Fed's COVID-19 response. The Federal Reserve has literally thrown the kitchen sink at this problem. I've never seen so much things happening from a standpoint of regulators telling us not to count loans as delinquent, to extend loans for 3 months, to do all sorts of things, to charge less in fees, to really do everything we can do to help out our customers or members. Unprecedented, especially compared back to how regulation responded in 2008, 9, and 10. And not only has there been this amazing viewpoint of regulatory encouragement to really do the right thing and to help people in this time frame, the Fed has also thrown nearly $3 trillion to this point at the problem. We've heard a lot, obviously, about the Payroll Protection Program, the PPP. Now it's $660 billion. The Main Street Lending Program, which is another $600 billion program, is kicking off in the next few days. And then we have the $850 billion in primary and secondary market credit facilities, and then $500 billion municipal liquidity facility. So huge amount of money being thrown at this, and we expect that it's going to probably continue. There are a few more bills in Congress being discussed. I don't know if they'll make it through, but definitely an unbelievable amount of money being thrown at the economic problem related to COVID-19. In our economic summary that we published, it really gives us down that we should focus on what happens post-COVID-19 or post-crisis time we refer to as post-boom. And you know, it doesn't help for us to talk about it because we can turn on the TV and see all sorts of opinions on where this is going, where we've been, and what's happening. But from an economic standpoint, we look at this as there's two most likely outcomes. One, and those that you know me, I'm a glass half full person. It's the hopeful outcome that the infection and death rate continues to fall. There's no second or a very limited second wave of infections and a vaccine's developed. If this happens, we expect to see a pretty quick V recovery. And the other side of this is the challenging outcome. The infection and death rates stay the same or increase, a strong second wave of infection start, and there's no vaccine that appropriately works. And this is going to push a much longer recovery. So as we think about the economy today and we think about everything that's going on, we plan for this range of a 3-year, 4-year type recovery and a maybe a 1 to 2-year type recovery, we should be covered in these two areas. But at this point, we don't know about the second wave of infections. We don't know about a vaccine. So we should be thinking of these two potential outcomes. With that, one of my favorite graphs, those of you who know me, this is the Fed funds rate in red, the 2-year Treasury in blue, and the 10-year Treasury in a black dotted line. As you can see, recently we fell off the cliff, going from about 175 in Fed funds to 0. Very similar to what happened in 2008, 2007, 8, 9 timeframe. But the one thing is very different is we're going to see here when we compare right here in 2012, really the low level of interest rates that we hit to today, what's different is really the 10-year Treasury. If we look at a picture of the yield curve, the black dotted line is 2012 and the red dotted line is effectively today. And what this shows is that the economic position today is very, very different, meaning that long-term yields are substantially lower. It's a flatter yield curve, which really hurts us from a loan standpoint. Loan yields are much lower when we get out to this 5, 7, 10-year time frame, and that's going to cause some earnings pressure on us. The Fed is in the same boat as the yield curve. The yield curve says rates are going to be low for a long time. Our projection here in our write-up was that we're going to be at this low interest rate environment for at least the next 5 years. We should plan on this because of slow growth, uncertainty, low to no inflation, low rates around the world. The Fed here, all the Fed funds futures are implied that there will be no rate change, and we're going to stay at a range of 0 to 25 for the foreseeable future. Some of the things that really affect our industry, auto sales. Auto sales have dropped off the cliff here. Big part of the reason, a lot of states are a little bit nicer than Michigan. You can go and buy a car, but in Michigan, they've made it dealerships shut down and difficult to buy cars. There's no auto manufacturers working, although we just started back up this week, I should say. But we have inventory declining substantially and sales declining substantially. Would expect this would recover, but we're all not driving as much as we used to, which is why oil was all over the news this last week. Last 2 weeks, we talked about oil getting down, oil futures at negative rates, all sorts of low levels. In the end, what we didn't hear is that oil is back up. We were down around $20 a barrel. We're now back up almost to $25 a barrel. We're beginning to see some demand kick up, and Google let us know that they're tracking 25 million more cell phones leaving their houses this week than left last week. So the economy is slowly starting to open up. If our governor or other governors want it or not, we're starting to see people move. Gross domestic product, obviously a major stop of activity in the country, major stopping of sales. We've seen them plummet dramatically. Even though the first and second month of the first quarter had positive GDP growth, the third month having as much negative, we ended up with nearly a 5% drop in GDP. Given where we are in the second quarter, we should expect to see more of a drop of GDP as we go forward here. So this is not as bad as 2008, 9, 10, but still a very significant decline. Unemployment, we fell off the cliff upward here. As I wrote up in our economic update, we see unemployment at close to 20% right now. As of this chart, the United States is running at 15%, 14.7. Michigan's still a bit behind on reporting at 4.1, but we do think unemployment is in the 20% range, substantially higher than we ever got in the 2008, 9, 10 recession, but hopefully a lot of this is because of forced closures and temporary, and we see a very quick rebound. With that, there's very little inflation. We're seeing right now roughly 2% rate of inflation, ex food and energy. We actually include food and energy, it's lower. The biggest component being gas prices are substantially lower as people are not buying gas because they're not moving around. Food prices are up due to some shortages, and that's what's keeping this up a little bit. But in the end, we do not expect any serious amount of inflation now or in the foreseeable future. And one thing we are seeing is because of this change of spending habits, we're seeing people have a lot more money, and we're seeing savings rise substantially. We're at a 40-year high in the savings rate. I do expect that we're going to continue to see savings deposits, cash balances continue to rise at all the institutions on the phone here, as people are saving because they're concerned, but they're also saving because it's really difficult to spend when you're locked in a house for a number of months. Speaking of homes, home prices still are doing well. We obviously have seen a stop in a lot of sales, not many price adjustments yet because it's not a necessarily a price question, is can you get into a house or not? So really interesting, can you get in to have a showing? A lot of places you can't. We've seen virtual showings kick up, and now we're beginning to see some showings come back online. I do think that home prices should continue to remain reasonable in this environment, not have a big reduction like we had in 2008, 9, and 10, as this is not a housing crisis. And in some ways, a lot of people living in apartments are going to want to move to homes. Well, one of the graphs we introduced in the last few years was this international yield chart here, and comparing. And back in 2016, 17, even all the way back to 15, we started to diverge from our comparable countries. The United States in a lot of ways is similar to the UK, Germany, and Japan, democracies, long-standing good economies. Well, we've quickly reverted back to those three countries, and we're all now darn close to zero, us a bit above, Germany a bit below. In the end, I expect that this is one of the reasons that we will stay at low interest rates, is there's really no inflation in many of these countries, and the U.S. is the best economic country out of the bunch. So this does show that world levels of interest rates are also this low, causing things to be where they are. So for our first polling question, we'll kick off here, and you can answer it by answering the question. Following the onset of COVID-19, how much did the S&P 500 fall? 25%, 35%, or 45%? It's a great question, a bit scary in a lot of ways. We saw things definitely fall dramatically. And as we're coming in here on votes, got about 70% of people voted already. And the next question, which I'll answer, is going to be fun, is how much are we down today? So we'll end the polling now. And as I share results, 58%, say 35%, and that would be the correct answer. And we are down 35% at the low point. And where we are today, though, is not as bad. We're only down about 10, 11%. So we drop on the S&P 500 from 3,400 down to about 2,300, and now back up to around 3,000. So been all over the board, massive recovery after a massive sell-off. Maybe a little bit ahead of ourselves, some may say, but definitely an interesting spot. So where we see the economy is that the economy is subject to the opening by states, subject to a vaccine, and subject to the depth of the problems we have. We think there's a short-term potential outcome that rates start to, and the economy improves as we don't have a second large outbreak and states open up and we get back to normal by the fourth quarter, a new version of normal. The other side of this is that if we do have a second wave, this may take us a few more years of this difficult environment and definitely cause some issues. Unemployment has been saved by a lot of the issues with having the enhanced benefits right now for unemployment. And with the combination of that and the extension of a lot of loans for 3 months, I don't think we're going to see much as a level of increased delinquencies or loan problems until we get into the August, September timeframe, and maybe even into the fourth quarter. So it looks like numbers will be good until then, but that's when we'll start to see some concern really pick up as the 3-month extensions and the unemployment bonus levels start to come down or end. So with that, I'm going to hand the meeting off to Chris and have Chris talk to us about ALM in this post-COVID environment. So,
okay, great.
Thank you.
Great, thanks, Charlie. Well, good afternoon, everyone. And again, thank you for joining us today. You know, at difficult times like this really stresses the need for having quality resources at your disposal. And ALM is no different, right? In the current environment, your ALM report is going to be a valuable resource to you. And we wanted to just talk about that a little bit today and remind everybody of how the reports can be used as a tool for your institution to take you forward into this environment the best we can. I'm going to steal an analogy from a coworker, Mark, who said ALM kind of tells you how strong your boat is to weather this storm. And I really like that. So I use that sailboat image there on the screen. It's really, you know, the snapshot of your balance sheet and throws you into different risk scenarios in the various rate environment. And all too often we've talked to institutions over the years and they've admitted to me, well, I just put these reports in a drawer for the examiner. And I get chest pains when I hear that. We've really always advocated using these reports as a tool. So if you have a quality report, it should be a valuable resource for you to get through environments such as this, to put yourself into different scenarios and talk about it with a provider here such as McQueen to see different scenarios of what are potential different outcomes during this types of environment. Next slide, please. We probably have a lot of tendency to, during good times, like such as the past few years, probably just take a look at the summary reports and say, okay, we're within our parameters and just file it away. Now that we're in a little bit of a difficult environment, it's really important to dive into your reports in more detail and see where are some potential problems, what are some potential changes that you could make on the balance sheet to help you get through this storm. So in your more detailed reports, we really advise you to take a look at certain areas that'll give you some more insight into how the next few months will play out at your institution. In any ALM review, you should always be taking a look at what is my worst case scenario? What interest rate environment pushes me over the edge, if any? What line items impact me the most? Most of you probably are aware of what items on your balance sheet really do have a market value fluctuation greater than others. But again, if you're new to the institution or you haven't looked into that in a while, it would be a great exercise to do. And we're going to take a look at that on a few slides later. But what line items impact my net economic value the most? What line items impact my net interest income the most? Where can I go into the report to take a look at that a little bit more detail? What adjustments could I make to manage risk or improve profitability? If you see that your ALM report is showing that in a plus 300 environment, you fall outside of policy metrics, where do you have to go? What adjustments do you have to make at your institution? Could we improve profitability? Could we take on more risk? Those are the kinds of questions you can ask looking at your ALM report. So again, great resource for you in a difficult environment or in good times as well. So we really try to strive to use this as a tool to get through these environments. And lastly, and probably most importantly, what is the impact to my capital? Do various interest rate environments put my capital at risk? What types of fluctuations do I see in the various rate environments? Some of you may see just very little fluctuation, some of you may see greater, but it's important that you have an understanding of the impact to your capital in various environments. Next slide, please. I can't let a conversation about ALM go without talking about how it really should be reviewed as a process at your institution. Again, it's not just a report that gets filed away in a drawer. It's really an all-encompassing process that involves many levels at the credit union or bank, whatever your institution is. Starts with a policy. Interest rate risk policy always should be reviewed on an annual basis. Make sure it is really reflective of your institution. If it's a policy that was written years ago and you've just recycled it over the years, make sure it's really reflective of your personal risk preferences at the institution right now. Oversight and management in the ALM process, that involves the board as well. It's not just management at the credit union, it does involve the board. They should have an understanding of ALM. We always stress you don't need to know the intricacies of the modeling process, but when the reports are put in front of you, they should have a good understanding of what is net interest income, what is NEV, what do the different rate shock scenarios mean. So if you haven't had a board training in a long time, we definitely suggest that. It's always good to keep your board up to date on new trends in interest rates, what level the interest rates are at now, putting the ALM reports in front of them. They really need to understand the risks in front of them. So it's always recommended that board training happen on a regular basis with ALM. Measurement and monitoring, this is where McQueen comes in as your advisors. And it's not just the reports. We really always recommend you go over the reports with your ALM advisor to get a second set of eyes on the report. It can always help having somebody else come in from an outside perspective. What are we seeing on your ALM report versus what you're seeing? Maybe we're focusing on something different. We can also tell you what we're seeing with some other institutions, whether it be in your geographic area or maybe institutions of your size. So it's always important to get an advisor to go over the report with you. It's always a second set of eyes, can't hurt. Internal controls always separate the risk taker from the risk assessor at the institution. That's a very important separation. And lastly, informed decision-making with the ALM process. Use the reports to your advantage. Don't just file it in a drawer. What type of risk are you facing in the current interest rate environment? What type of impact to your NEV? What's the impact to your net interest income? Take a look at the reports. How can you use that as a tool, a resource going forward? Again, all part of this continuing process with ALM. Next slide, please. My last comment on the model itself is always that your data in is only as, your data out is only as good as the data in. Your model output will be best provided with the most current up-to-date data from you. This includes your current offering rates, your current loan rates. We really need the most current information, most up-to-date information. Model parameters should always be reviewed on a regular basis. Annual assumptions should be reviewed by the board and management on an annual basis, at least annually, if not more frequently, depending on the environment. If the environment changes, do you need to change some of those assumptions? You can even take it a little bit further in your modeling. Do you want to take a step deeper? Items such as back testing of your net interest income. How have your projections in the past looked going forward? Should there be some adjustments made? Prepayment analysis. How has your membership paid their loans off? Are they in line with the national average, or does your membership show a slight difference? Those can be dived into in further detail with your ALM advisor, and we'd be happy to talk to you about that. So again, refining the model only creates a better report for you. So we're very big advocates of making the model the most representative of your institution that it can be. Okay, so let's talk about what's been going on right now. I know Charlie had this slide up with the Fed funds rate just a few minutes ago, but I don't know if anybody caught how long we stayed at that Fed funds effective rate of 0. If you were in the industry during that last cycle, it felt like an eternity. But what was the time frame on that last cycle? Was it 6 years, 7 years, or 8 years? I'll give a few minutes to answer that. Unfortunately, we're back there again. But again, if you were investing during that time, if you were lending during that time, it was very, very painful, and it felt like it was taking forever. So how long did the Fed keep rates effectively at 0 before they moved?
You know, Chris, I was hoping for like a 10-year number here, as it felt like a long time. And
I wanted eternity on there because that's
yeah,
what it felt like.
we did have a great projection back in 2008 when this was falling apart. We did put out a projection that rates would be low for 10 years. And we were right. They were definitely low for 10 years, and we got that right. But they weren't at 0 to 25 for 10 years. So, but
Charlie and Chris, this is Dan. I would also note how interesting it was. So many pundits expected rates to increase pretty rapidly throughout that 0 rate environment, which that didn't pan out as quickly as they expected.
yeah, that's a good point, Dan. A lot of people said, and as we wrap up and end our polling here, that's why we're saying at least 5 years at this point of low interest rates, if most likely longer. So with that, Chris, there is a split group here. What is the correct answer?
The correct answer is 7 years.
Yeah, so it's definitely a very long time, but 7 years. So let me share results. I apologize. I hit the wrong button. So I'll share results to everyone there. And
Oh, it was very split. Yeah, yeah.
Almost 40, 40, 40.
Again, I'm going to guess that 8 years was people who were definitely in the industry at that time because it felt long. But I do have the graph on the next page to remind everybody of that pain. It was the end of 2008 to that final move there in December of 2015. Again, it was baby steps too. It was those 25 basis points. So again, it felt like it took forever to get out of this, up to 2.5 at the peak. And now, of course, plummeting back down to 0 again. But one thing that this graph really brings to mind, again, if you were in the industry at that time, I remember in 2009, 2010, even into 2011, some of my clients had 5% coupons on their investments or higher loan rates than we have now. We had a little bit more of a cushion than we do now. 2.5 was good, but again, it was not what we were at during the last cycle. So we're kind of operating with a tighter margin at this point too. So it's important to keep that in mind. I know a lot of times we're taking a look back to what did we do during the last cycle, but there are definitely some differences this time. Really hoping that we don't stay low forever, but unfortunately, you know, this has a long way to play out. So it is important to be aware of what a low interest rate cycle means for us. But again, remember, we don't have that cushion of the higher coupons that we did back in 2008, 2009 timeframe. So we're operating already in a tight margin. We kind of thought this going into 2020 before the pandemic hit, that we were going to see some tighter margins, and it just got amplified to the 10th degree now. So with that in mind, what do we think should be the focus on your ALM reports? Being in this environment before, we know some general effects. One of them obviously being lower net interest margins. Again, we were talking about this going into 2020. We had seen interest rates come down in 2019, and that was starting to show up on some repricing activity. This is just a sample ALM report that we saw, and just to bring it up on the screen here, you see the trend in asset yields over the 1-year time frame going from a 5.91 to a 5.37. Obviously, with loans coming due, you're repricing into a lower environment. This includes investments as well. Investment yields have been painful, as we all know. Just reinvesting, losing some good coupons in this market. We're definitely seeing that asset yield fall, and we would expect it to continue to fall throughout the year. Stresses the need to keep funds working. Get something better than your overnight rates. Keep your money to work in this environment. Liability costs. In this situation, this liability cost has stayed pretty steady, but you may have heard, definitely Charlie over the past few months has been very strong advocating get the liability costs down where you can. Can you lower your term deposit rates? Can you lower your deposit rates? This is a cost that you have some control over, so if you can lower those rates, that's going to help be a little bit of a help in this environment. Again, we're really coming under pressure on those asset yields. Net interest spread, net interest margin, obviously carrying through from those lower asset yields. You can see the trend there on the year-over-year basis from March 2019 to March 2020. So again, this is the big obvious one. The big focus this year is going to be that net interest margin compression. With that, the biggest concern obviously is that net interest income figure for 2020. And again, diving more into your ALM reports, some areas you want to evaluate. If you haven't done this more in the past, go into your detailed report and take a look at some of your repricing activity. I pulled an example from the sample ALM report down below. In this situation, this is just a few loans for this institution to fit on the screen here, but you can see there we have their total balance on indirect used and indirect new, and you can see the buckets of when they mature over the next year. So some of you may see a lot of repricing over the next 3 months, maybe some of you have it down the road 9 months into the year. You can see the type of coupons that are coming off the books. So it's really important to dive into and see the activity that is going to flow through over the next few months. Again, this is a very fluid situation. Some of you have people going back to work. Some of you are still on hold in your state. So it really varies across the country in regards to the activity that you're going to see. But it's really important to see what type of loans are coming off the books. Can you replace that volume in the current market? Can you replace those rates in the current market? And a lot of this might be a struggle for some places. So again, dive into the more detailed reports to take a look at this. Pricing on deposits we've talked about. If you can lower those costs, it should help the cause a little bit this year. 2020 budgets. I've talked to a lot of clients who've said, you know, I'm just throwing out the 2020 budget. We have to redo it, and we completely understand. Your ALM report can be a little bit of a guide there, and we'll talk about that in a minute. And the last thing I just want to touch upon is optionality. If you have callable investments in your investment portfolio, chances are you're seeing them get called at a rapid pace. I don't think any investment is escaping being called right now if it's got a call feature on it. So unfortunately, not only are we seeing the cash come back to you, but you also are losing probably some good coupons on the books as well. So be aware of how much optionality is in your investment portfolio and your loan portfolio as well. Next slide, please. As I mentioned on the 2020 budget idea, if you are looking to redo that budget for this year, take a look at the ALM report, especially if you get that March 31st report for this year. Take a look at the line items that you provided us with. Do those have to be adjusted in lieu of the projections on your total interest income? Line items being non-interest income, non-interest expense, provision for loan loss. I've had several conversations with institutions regarding that. I know a lot of you are looking at reevaluating your provision for loan loss this year with the uncertain economic situation. So take a look at the March report, see how these line items that you provided us with earlier in the year are now affecting your net income figures. What kind of adjustments do you have to make for that going forward into the rest of 2020? Next slide, please. To take a step back, I know we've been kind of talking about rates staying flat, and we're much more focused on net income figures this year more than the rate shock environment, but that's not to say to never look at the various rate environments. It's something I've been very guilty of over the years. Your eyes tend to go where you think things are going to happen. So we don't think too much is going to happen in the plus 300 environment, so we don't tend to bring our eyes there. But always remember that your examiner will take their eyes there. So always be sure to look at every rate environment. Take a look at where your percentage change is in relation to your policy limits. In this example, in the plus 300 environment, the percentage change was down 17%. Their policy limits were 30, so they're well within their policy metrics. But if you're trending towards that policy limit, or if you are in violation of the policy limit, even if it's not a rate scenario that is anywhere on the radar, an examiner is going to say, hey, what are you going to do about this? You need to know where you stand in relation to your limits, and also what adjustments need to be made if you're outside of them. So again, we're not thinking that rates are going to change anytime soon, but always kind of train yourself to look at every environment when you do get these reports. I mentioned this earlier too. This is the whole idea of taking a look at what areas impact that NEV report, what areas impact your capital. Take a look at the market value fluctuations of the various line items on your balance sheet. For example, in this situation, we've got 15-year mortgages, we've got 10-year mortgages, we've got used autos. The used autos in this situation in the plus 300 environment take about a 4.5% market value hit, whereas the 15-year mortgages take about a 10.5% hit in the plus 300 environment. It's always important to know which areas have the most impact on your balance sheet. I know a lot of you are well aware of that, but if you've had any shifting in terms of product offering or just shifting in the balance sheet, it's always important to dive in and say, what impacts me the most? Because if you ever have to make any adjustments, this is the kind of information you need to dive into. I mentioned using ALM as a tool many times during my session here, and the ALM team here at McQueen came up with a great resource this quarter to help any of you talk through some of these numbers that you might want to be adjusting. This is a spreadsheet that they created, and the starting point is your actual ALM results for March 31st. What you can do is take that information, and in the middle of the page there, you see an adjustment section with some yellow cells. What I did here was I adjusted non-interest income down 200, and I adjusted the provision for loan loss up 200, and you can see the impact that it had on the new impact down below on ROA, net income, and net worth. Again, just a great tool to play with to give you some idea of what kind of adjustments you can make and the overall impact to your institution. And lastly, before I hand it off to Dan, he's going to dive into ALM in a little bit more detail. Just remember that ALM is one type of risk at the institution. It's not everything. It does not take a look at cyber risk. It does take some credit risk into account, but that's more an idea like CECL. We'll take a look at those. And lastly, although we've plummeted on interest rates, just remember that this situation is a little unique. We're not in a traditional low rate environment in the sense of should you be expecting pickup in prepayments, et cetera. Remember the economic strain a lot of people are under. We're probably not going to see a lot of prepayments on mortgages. So don't always build that into the current situation. Fees are another one for non-interest income. I'm talking to a lot of clients who are saying, you know, we have to waive our fees in the current environment, or they're not seeing the level of fee income that they're used to seeing just due to lack of activity. How does that impact your non-interest income in this environment? And lastly, I think everything comes down to really knowing your client base, knowing your membership. Some of you out there that I've talked to have an educator base membership or a public service membership who still have their jobs. They have the cash flow coming in on a regular basis. Others may differ in that. So really knowing your membership is really key to making those assumptions into your ALM model for the remainder of this year. And with that, I'd like to hand it off to Dan.
Well, let me kind of, Chris, just real quick. I really appreciate your comment that this is a different environment, and every crisis is different. You know, we talk post-boom crisis as being different, and here what really makes this difference is the low yield environment on the long-term treasuries. We've not been in this environment. When we were in this last low Fed funds environment, we had higher 10-year treasury. So I do think one of the things that I'd want to do is prepayment speeds are not going to be equal. And Chris, your point is very good that some loans may not prepay because people don't have the opportunity to. But for your customers or members that have the ability to refinance mortgages, it's an amazing time to generate non-interest income. So I'd make sure that you're thinking about all the things you can do to generate non-interest income in this environment. And one of the areas we've seen a lot of non-interest income generation was the PPP loans, people writing those, generating the fees off those. And some clients are actually taking all the fees they received from that and put that against or add that to their provision at this point. So it is going to be different, and I think, Chris, you have a great viewpoint on that, and I think we have to think about everything a little bit differently, but focus on non-interest income as much as we can, and focus on our margin. As you pointed out at the beginning here, this is definitely going to be a tough margin environment.
Absolutely.
Cool. Okay. Thank you very much, Chris. Really appreciate the insight, and we'll hand it off to Dan to talk a bit about ALM validation.
All right. Well, thank you, Charlie and Chris. Chris, that was great information. And certainly, as a consultant and working with clients just on the ALM reporting, I think everything you highlighted was spot on. So the last segment of today's webinar, we're going to discuss the importance of conducting an independent ALM model validation. So first, we know that financial institutions rely pretty heavily on a lot of quantitative analysis and complex models. They use that for forecasting, budgeting, valuations, capital planning, of course, but ultimately for decision making. An ALM model validation really is a process to test and verify that your ALM model is working as it's intended. Is it functioning consistent with its design? And ultimately, is it producing useful results for management? We know that all financial models have some element of what's called model risk. That's really the introduction of data errors, assumption errors, or other components that diminish the accuracy of the model results. As Chris highlighted earlier, that your ALM model is really an important tool. I couldn't agree with that more. So you want to use this tool in a correct manner to achieve really accurate and useful results. Last, we know that the regulators have guidance and requirements for running an ALM model validation at some periodic frequency. So these are all important reasons to keep a model validation on your radar. We certainly know that this year, with everything on your plate, that is important, and we encourage that. So the next slide here is really a diagram of an ALM model. A lot of moving pieces here that got to work together to formulate an accurate interest rate risk profile. The goal is to really help the management team understand how is the balance sheet going to behave under different interest rate environments. That's really, again, we're echoing what Chris had talked about earlier. As with any complex tool, the model has to be set up correctly and be maintained to ensure it's working properly. And then equally important is the knowledge and skill set of the person who's going to operate, not only operate, but set up and operate the model. Next slide. All right, before we go any further, here's our last polling question for today. When should an ALM model validation be performed? A, after a merger has been completed. B, after switching an ALM model or an ALM vendor, if you use one. C, material changes in the balance sheet composition or complexity, or all of the above.
You know, Dan,
I'll let the audience look at this.
Yeah, it's interesting. You know, to get CPE credits, we have to ask 3 questions, and sometimes we put some questions that are tough, and sometimes we put questions in there a little bit easier. And so we're gonna end the voting here pretty quick because we have a fairly high percentage of people voting for all of the above, which really makes sense when you think about the world that we live in. So we're gonna share results here. We're at 98%. I cut off polling a little early here of our 230 or so people voting today, but we're definitely all on the same page here.
That's good. We have a very intelligent audience. Awesome. So wonderful. So Charlie, the next slide. All right. So why consider an ALM model validation in 2020? Well, first, we know that the Fed has cut the Fed funds target rate a total of 225 basis points since going back to third quarter of 2019. pretty substantial drop. We know in March of this year alone, the Fed cut a total of 150 basis points in their 2 unscheduled meetings. It's pretty unprecedented. And as Charlie mentioned earlier, the Fed has established, revived, expanded various other programs to support liquidity in the marketplace. They've essentially thrown in the kitchen sink. So a pretty substantial change in the interest rate environment, both in the last 6 months, but also the next couple of years, what we anticipate. Next slide. All right, so beyond the Fed's rate cuts, numerous other factors should really compel you to look at performance validation this year. We know that the 10-year Treasury has fallen to historic lows. That's really caused spreads to be pretty volatile, especially on mortgage-related assets. Those are certainly very sensitive on your balance sheet. Mortgage loans, mortgage-related investments. So you've heard Charlie talk about comments regarding the unprecedented impacts related to COVID-19. And this is both from a social perspective, business perspective, economic perspective. So that's certainly important. All of these factors are changing your balance sheet composition and your earnings expectations over the next 12 to 24 months at a minimum. A large inflow of deposits. Certainly it's creating a greater cash flow uncertainty. And that's likely changing the duration profile on your balance sheet, on both sides of the balance sheet. So when this is happening, you've heard us talk about margin compression over the last couple of webinars. That's the big focus that we want our ALM model to be able to identify, help us formulate, and get a handle on it, and then decide on what we can do to mitigate and correct it. Next slide. All right, so again, why do a validation in 2020? Ask yourself these questions. Your board, your ALCO and your board are strategizing on ways to navigate in this zero rate environment. And these are certainly important. You know, have I updated my key model assumptions for the March 31st, 2020 run? What should I be doing maybe in June 2020? Again, some of that's going to be dependent on what we're seeing in the next couple of months. How accurate were our interest rate, our net interest income projections over the last 2 quarters? You know, is our model giving us good results already that we're confident with, or do we need to look at it more carefully? Am I reporting enough earnings at risk information so ALCO members can make a good, meaningful decision? And then last, you know, what are we missing? You know, good thing. My father always used to say, you know, what do you know, or how do you know what you don't know? And that's really important when we come to something as sophisticated as ALM modeling and reporting. A validation can help flush out those elements of your process and model that need some corrective action or adjustments. Next slide. All right, so as we move through and out of this crisis period, we really think you should do an assessment of your ALM model. You know, since the 3rd quarter of last year, again, when we saw interest rates begin to drop pretty rapidly from the Fed, how did your model project essentially a 200 rate drop? How did your core deposit repricing assumptions hold? As rates were dropping, did you change your core deposit pricing as you expected? When we start looking at other elements of the model, you know, how did my model handle variable rate instruments? Were my resets and my rate floors working as I expected, or were they even in the model correctly? What about cash flow optionality on loans and investments? Are we capturing that risk? Again, Chris mentioned this earlier, as rates have dropped on the investment side, a lot of investment callables should have probably been triggered. Did your model capture that correctly? And did you see that from a cash flow projection? Again, reasonable modeling input should give you good results. And, you know, even beyond interest rate risk, are we capturing the shift in liquidity? And last but not least, have you introduced any new loan or deposit products that you've never modeled before? All of these are important, valid questions that would support having a validation done. Next slide, please. All right. Now that Chris and I have discussed the importance of your ALM model, it really is a decision-making tool. And I've highlighted a lot of reasons why a validation should be performed this year. I'm going to leave you, this is really a list of goals and objectives that you would want to achieve when you initiate a validation, whether it's internally through your own resources or whether you outsource it to a partner, an ALM vendor. These are all straightforward takeaways really from today's session. For the sake of time, I'll go over a few of these items, but really the importance, and Chris alluded to this earlier, the quality of data going into the model, the way the model is set up and the account structure. Those are all important. Data going in correctly, it's going to improve the chances of accurate information coming out. You want to be able to reconcile to your general ledger, your balance sheet, make sure you've captured everything. And probably the last two important pieces is your current risk position, whether it's March 31st, do you feel that's accurate? You really have to start with a good base risk profile in order for those rate shock assumptions or gradual rate shocks to be meaningful. And lastly, can you identify the most important, the primary sources of the risk on your balance sheet? Those are all takeaways that a validation and someone else looking at that for you would help flush out. You really want to improve the decision-making of the model. Ultimately, be able to ensure that the organization, your ALCO, your board, you're in compliance with the guidelines that you've established. Next slide. All right. Really, as you're preparing for a model validation, this is a typical list of what you would be expected to compile as the firm's going to conduct a comprehensive ALM model validation. You can see it's a pretty substantial list. It includes not only data sources, getting a complete snapshot of what your model assumptions look like, all of the output, but it's essential too to look at what your policies say, and more equally important, what is the management team doing? Are you discussing these important elements in ALCO minutes and board minutes? Do the ALCO and board members understand the ALCO parameters to some degree? That's pretty important. And again, the validation can help support that process for a long-term success. And as we wrap up things today on the next slide, I want to leave you with this. This segment, it's really, I want to remind our audience that McQueen Financial Advisors, we got a team of seasoned ALM experts to help you understand and improve your ALM interest rate risk program. Not only the process that you have, but how you execute that process. The key area of a validation, whoever does it, is to help you identify if there are any gaps in your ALM interest rate risk process. Ultimately, we want to be able to substantiate the model and make sure it's reasonable and supportable. Again, the goal, I've mentioned this earlier, is to build confidence in your ALM modeling process and the reporting mechanisms in your organization. At the end of the day, again, both Chris and I feel it's very important. This is a great decision-making tool that should be used. You're probably spending a fair amount of time, resources, and expenses managing your ALM interest rate risk process. The modeling time, the reporting, all of that. You sure want to make the best use of that and get the most out of your dollars from an ALM process. So given all of the noise in today's market with the challenges we face, we certainly don't think that the ALM validation should be put on the back burner this year. And we encourage all clients to look at this maybe later on this year. With that, Charlie, I want to wrap it up and turn it over to you. Thank you.
Well, thank you, Dan. I appreciate that. We've got a number of questions that have been coming in also that we'll get to answer here in just one moment. As Dan mentioned earlier, I wanted to give you guys a few recommendations on a go-forward basis, and those of you that have attended our last few webinars are not going to be surprised by number one is lower all deposit rates immediately. People are saving money with you because you are the trusted advisor, you're the trusted institution. They want their money with you. Also, we have to remember, investment yields have dropped like a rock. Very, very hard to get anything above 1% yield today. And if you start thinking about that compared to where you are, it's really, really important to run down that path. Loans, do not lower loan rates if at all possible. You're going to have to lower some for competition, lower some such as mortgages. But if we're being competitors, it's really good to sell those and take the gain on sale today. It's nice to have that income in uncertain times. Make careful credit decisions. Not every industry and not every state is treating every industry the same. Right now, if you're working in multi-states, you have to be very careful about the open nature or lack of openness. As I take my jab at the state of Michigan locking things down, we have to be very careful on what we loan money on today, given those things. On the balance sheet side, carefully monitor your liquidity needs. There's a ton of cash right now. We are seeing people save money, so you probably have way too much liquidity. A lot of people are incented or tempted to borrow at this time frame. Something we need to understand a little bit more about the environment, how long we're in. And then if you are going to leverage your balance sheet, I said only here with non-maturity deposits, but I also think it's important to go down the path of using, if you have the PPP loans, to get the funding by the Fed to remove those completely from your balance sheet. So a couple quick things to look at and talk about today. And I think I really want to thank Chris and Dan here, because everything today is really about margin compression. How do we survive margin compression? And going through and having a good understanding of your interest rate risk position is the most important component to that. Delinquency is back to normal and probably going up a lot faster, but it's at least normal today. We'll see what happens when we come around to September. And losses are back to normal today, and we expect they're going to be elevated when we get around to September, October. Prepare for lower earnings, and it's okay to have lower earnings. We have capital for a reason. We're not going to be happy about it, but don't burn the ship down because earnings are lower today. Make sure we're thinking about long-term success and understand that having zero earnings for a year is not that big of a deal, especially when we're in a pandemic, which we haven't had one of these since the early 1800s, or early 1900s. Focus on the margin again, and then non-interest income was the last component I made earlier. Whatever you can do to get non-interest income and continue to grow it is going to be something extremely important. So with that, we want to answer some questions. We had a number of questions come in, a couple that were duplicates here. But one of the questions, which is directed about ALM validation, and if we use McQueen to do our ALM validation, can we use McQueen Financial to do our ALM reporting? Can we have them do a validation? And the answer is no, we cannot validate our own model, but one of the things we can do is a back test on our own model, and we can back test and show what has happened compared to what we said has happened, and we can show that. Back testing is a light form of an ALM validation, and sometimes you can do that, but you always want an independent party to do an ALM validation. Next component question that came across is, will we share the slides with your team? Absolutely. We're happy to share these slides with you. Please reach out to your advisor. Your advisor at McQueen Financial, your main contact, will get you a copy of these slides. And I do love this question. This is a good one. And, you know, Chris, there was a question about assumption reviews, and you had a comment in there about annual assumption reviews. Does it make sense to review your assumptions more frequently, especially when interest rates are changing so dramatically and products are changing so dramatically?
I think it's a very worthy discussion, you know, whether you want to tweak everything in your model on a regular basis. I don't know if you'd want to do that, but I do think it's a very worthy discussion to have among everybody, among management and the board at your institution.
Yeah, I think it's a great point, especially when products change and you maybe change your products because of the environment. It's a great conversation to have.
Yep. Charlie, and I would add, I mean, this is a perfect environment where a traditional drop in mortgage interest rates has not initially resulted in the big wave of the refinancing wave. And that's because of, you know, certain conditions in the market with, unfortunately, with the COVID-19. But assumptions should always be looked at, especially when there's a meaningful change in the market environment, in the environment which our model is set up to behave in, and those assumptions can change. So yes, they should be reviewed, especially in cases like this, more frequently.
Yeah, it's a very good point. Very good point there. And another question that came in was, how often should we hold board training on ALM? Chris, if you want to take a stab at that, or Dan, I don't know, whoever wants to answer that.
I'm always a huge advocate of it every year, but I know that's a tough one for a lot of places. You know, at least every couple of years, I think there should be some kind of formal training. If not on an annual basis, at least go over the terminology, make sure everybody's comfortable with it. But I think the more your board is comfortable with the reports, you know, it's just, you know, better for your institution.
Very good point, Chris. Thank you very much. All right, another question that came across, which is a great one. Invest in what? Not a lot of good value out there, and I'll answer this. It's definitely a difficult environment, and you know, when you look at things, Treasury yields are terrible. Bullet agency yields are really tough. There is some value in the municipal sector, taxable or tax exempt, and both sectors actually. And it's hard to find a significant volume, and especially of things we like. Our credit team is really looking carefully at municipalities and types of debt issuance. Is it based off a parking lot for a sporting arena? You know, how is that going to play out? That is a very scary potential thing. We've got to be careful there and look and make sure we're looking carefully. So our investment advisor team is finding good things. So there's also some good value in corporate bonds. You know, you got to again be careful. You don't want to potentially maybe buy an aircraft manufacturing company for some strange reason right now, or maybe not a hotel company, but there are a lot of corporate bonds that have been caught up in this. And then last but not least are bank notes. We're seeing some good value in bank notes, and it's a reasonable spot. So those are areas where we can get some decent yields, and it takes a bit of effort and time. And CDs used to have some good yields. There's still a little bit left there, but a lot of the names people already have, and it takes a lot of effort to buy a bunch of CDs to fill in numbers. So all good questions. You know, another question that did come in is why not borrow super low rates right now? I think the viewpoint on that is I like to borrow once I have an asset to fund, and to borrow money then go find an asset, you don't really know what your margin is going to be. And so something to think about with that is I'm always open to borrowing money, but I'd rather have my asset in place. And that's where, if a lot of people thought interest rates were super low 6 months ago, we had people telling us rates were going to go up 6 months ago. And you know, those of you that follow our economic write-ups, we've been talking about lower interest rates for several years. And not that, you know, I'm here to say that we were right. We're not right in every economic prediction. But what I want to put by that is there's going to be a lot of comments about where rates are going. Rates can still go lower. And what I'm mostly concerned about is getting good yielding assets on our books today. So that's my viewpoint. Find those good yielding assets, then borrow to fill in. And at the same time, in times of uncertainty, people save money. And when you're locked in your house, you save money. So with that, I really want to thank everyone for coming today. And we really appreciate you taking the time out of your busy schedule in this unique environment. Definitely a unique, scary environment. And you know, we work really hard here at McQueen Financial for everyone to take care of everyone. And if you have any questions or any needs, please do not hesitate to reach out to your advisor. We want to help. We want to help everyone, and we're here for you. So with that, thank you all very much. I want to give a big thank you to Dan. Great job in the presentation today. And Chris, thank you very much. Great job in your presentation. Appreciate both of your knowledge and expertise and abilities that you have. So again, thank you, everyone. Have a wonderful day. And a few more questions have rolled in. We'll send out a follow-up email with answers to those questions. Have a great afternoon and good luck with everything, everyone.
Thank you, everybody.